Yo, what's going on, guys? Welcome to episode 29 of the DeFi by Design podcast. Here today with the co-host, the man, the myth, the legend, Rob, who just absolutely crushed a bunch of math exams. He is absolutely in this to win it. Finally, he is ready. Rob, and we are here today with James Simpson. I sound like a true commentator, but James Simpson is from the mStable protocol, an Australian mate surfing it up in Costa Rica. We're here today to discuss all things DeFi, mStable, governance, stablecoins, all sorts of good stuff. We'll turn it over to Robbie. How are you doing today, Robbie? What's going on?
Andy, my guy, I know we've been doing this podcast for quite a while, but I think it's time NBC offers you a slot on the Tonight Show or something. As always, it's a beautiful day here in Florida. Sun is shining. Yeah, I'm ready to get outside today and really just kick it. Definitely been killing these exams. Graduation is right around the corner, so I'm happy to be done with class for the last 13 years like we've been working on. So super excited to be talking to James, part of the mStable team, and I'll pass it over to him, and he can go ahead and introduce himself and get us started.
Cool. Yeah, thanks, guys. I'm James Simpson, co-founder of mStable. At mStable, we launched the protocol back in May last year, started in 2019, really trying to solve some of the biggest pain points in stablecoin for stablecoin users. So we currently have a stablecoin AMM for USD stablecoins and Bitcoin, a high yielding savings account that's averaged between kind of 10 and 30% yield since launch, and that's just in pure USD yield. Yeah, and our swap product. So that's kind of a super high level overview of mStable. But yeah, great to be here and keen to kind of dig into some recent trends in DeFi and some of the stuff that we've been working on as well.
Yeah, so I was telling you guys earlier about the investment kind of sales banker dude that I was speaking with earlier, and showing him some of the yield on Aave and mStable and a few other places, and he was just kind of like perplexed at like what is and why that is. So James, I'm curious kind of what your explanation is to how mStable is able to get a 10 to 30% APY, and kind of why stablecoin yields, are high in DeFi right now. I know we're really just getting off the start, but what do you answer to a traditional finance or to an older person who's kind of aware of how markets work? Why are the rates in DeFi for stablecoin lending so high?
Yeah, it's a really good question. I think there's a question on like the base yield on Compound and Aave, and those dynamics I won't kind of jump into at the moment, but you can kind of get still a higher yield than you can get on your bank account, and that could be to do with some kind of risk profile that people are pricing into lending assets on DeFi as opposed to through a bank, and also potentially kind of a lack of supply of dollars in DeFi. Making those rates a little bit higher than they would be in the traditional markets. For mStable, the way that we looked at it is our mission from the very beginning was to unify stablecoins. Stablecoins generally have been an area in DeFi that have had a lot of fragmentation. So there's obviously like 5 major USD stablecoins, and before AMMs like Curve and mStable, it was actually pretty inefficient to trade between them. You often had to trade to Bitcoin and then Bitcoin to another stable coin, and incur quite a bit of slippage in the process. The way that that's kind of a problem, obviously, and we realized that you could actually create some interesting capital efficiencies by creating a smart contract that did a few things. 1, automatically lent out collateral assets. 2, simultaneously allowed those stable coins to be traded efficiently between each other, swapped, and then lastly, actually create a meta stable coin that can be redeemed for the underlying collateral. And really, it's just that simple idea of combining lending income with trading fees from our swap product that enables this really high yield. So on mStable, if you're in the savings account, you not only get a base yield from collateral assets that are on Compound and Aave, but you also get all the trading fees. You get the trading fees that the AMM the exchange product generates. So yeah, that's kind of a bit of background on how that works.
Super cool. Yeah. And I mean, it's interesting to see kind of the relationship that all these different pools play with each other, because they all have their own niche, right? Like Aave, Compound, mStable are all similar, but importantly different. Maybe you could kind of unpack that relationship between some of the ways that Meta gets APY and it earns interest compared to some of these other ones. And you mentioned the Meta token. That seems to really underscore a lot of the smart contract usage that is happening in the mStable protocol. Could you explain a little bit more how people are able to redeem and what that really means in terms of when people redeem, how that affects the system overall?
Yeah, so I mean, a way of thinking about mStable is that it sits above these more kind of base layer protocols. So I'd say like Aave and Compound are kind of these base layer DeFi protocols. A lot of different protocols and applications rely on Compound and Aave. mStable kind of sits above these, and we deposit our collateral assets onto Compound and Aave, but then we're able to be a bit more flexible with what we do with the protocol's collateral. So, for example, we're looking at one day rebalancing the collateral that's put into the smart contracts into the highest yielding protocol. So, if Compound's USDT market's generating higher yield, the contracts could automatically rebalance across to that. So that's kind of, just importantly, we can kind of choose where we receive that yield. We're always kind of earning those trading fees. And that's kind of magic about DeFi is you can really create these amazing capital efficiencies that just weren't possible in traditional markets. So you can actually use the same money to lend out, but you can also use it to trade, and that's pretty significant.
Yeah, it's like there's layers to the stack that, I mean, as we know, work together to enable these efficiencies in the market. And I mean, the way that I think about it is obviously you've got the money Lego thesis, but I like to think about it in the sense of there's different types of protocols that enable certain things, as you're saying, right? So there's Compound and Aave, which then mStable builds on top of, right? And there's layers to it. And one thing that this older dude was telling me, he was telling me about the arbitrage opportunities that are ever present in DeFi. We just did some very simple examples of, okay, how about you deposit 10K of USDC into Aave at 7%, borrow the same USD at 12%, bring it over to let's say mStable at 18%, and boom, you've got yourself a 7% yield, then 6% on what you borrowed, right? And so there's all these arbitrage opportunities available as well, which it increases risk, but it makes ever present that there's ways to use capital that we're kind of unveiling that have not been seen. And it kind of takes us to the Uniswap V3 launch, where there's a lot of hype about it, and a lot of things. And the number one thing from what I've learned about it is capital efficiency is a requirement for decentralized exchanges and for DEXs. The argument that Hayden was making was that TVL is not an important metric for decentralized exchanges. Do you agree with that, James? Or how do you feel about the concept of TVL when it comes to capital efficiency for decentralized exchanges?
Yeah, TVL has been like the metric that it's like a very easy metric to go by, but it's not necessarily a very intelligent one. Because we look at DeFi Pulse and you see that there's like $43 billion locked in DeFi, but it's often double counted. So obviously mStable's deposits are actually on Compound and Aave. But DeFi Pulse have mStable on the list, and also Compound and Aave. So the real number of TVL is a lot lower. And also it's important to realize that a lot of the TVL in the US, like denominated in USD, is actually the increase is just to do with asset prices increasing, like SNX and ETH just going through the roof. That said, I think it's still a useful metric to see kind of broadly the interest that users have in a certain protocol. But specifically in terms of AMMs, I think TVL is important to the extent where obviously you need deep and liquid markets. But was there something that Hayden was talking about specifically why it wasn't particularly important?
No, it was simply trolling about how with the concentrated liquidity aspect, you need, you can get the same amount of rewards or of fees by providing, say, a fifth of the liquidity. Instead of having your stablecoin pairs be provided from 0 to 10 range, you can just concentrate your liquidity from the 99th percentile to like the $1 percentile. And so you need, in that sense, a tenth of the amount. And so the argument was, isn't TVL just going to drop like a fly? And Hayden was explaining that simply he almost doesn't really care about TVL because he wants the maximum capital efficiency.
Yeah, well, I think that makes total sense. And yeah, I think generally, like TVL is like, we're not doing this in order to just have high TVL. It's about creating like much more capital efficient markets. So if that capital can be used elsewhere, and you can still have deep and liquid markets, then that's fantastic. And I think generally that's actually a pretty good way to be defensible. I mean, if big capital allocators will always choose the most efficient route for their money. So if they'll effectively just like stop. If this works out, then the large capital allocators will likely just deposit onto Uniswap, and they might forget about the sushi swap if they don't do a similar thing, if they can earn a similar yield with less capital.
Andy, that almost seems like the answer to your initial question of, when you were talking to the more traditional financer, and he was kind of perplexed why rates were so high. Well, the answer seems relatively simple. It's because there's more efficient movement of capital happening in decentralized finance than centralized. Because there's a lack of intermediaries, those people, well, not necessarily people, but those centralized entities aren't directing the flow of capital through their own entity for their own gain. It's, the peer-to-peer network, and capital takes the most efficient route. No matter what that route is, it doesn't have to go through any centralized entities in particular, because they want to capture some value for themselves. That gets away from kind of the TVL metric, but I would agree with kind of what you guys are saying with Hayden, that it's relatively unimportant how much money or how much capital is being stored in any particular contract, as long as that capital is taking the most efficient route for where it's moving. You're going to have really the highest rates possible for any given time period.
Yeah, I mean, I would also just say that I think a big, the largest capital allocators in the world, like the biggest hedge funds, for example, they are very efficient with their capital, and they kind of use prime brokers to collateralize assets that they have, and then create kind of streams of debt, which they can then invest elsewhere. And that's kind of what we're obviously very used to in DeFi. But the difference, I think, is that this kind of prime broker model is open to everyone. And it's kind of just embedded by default into the technological infrastructure. So if you deposit capital into Aave, you have a composable token that earns yield, that represents the capital you deposited and all future yield. And then you can use that to put into MakerDAO and mint DAI, and then you can reinvest that DAI somewhere else. And that's just kind of the default of how DeFi works. I think just something I would emphasize is that kind of a big revolutionary aspect to this is that it's capital efficiency for everyone by default, as opposed to just the few. And I think that kind of Hasu and Suzu from 3 Arrows, they call it kind of the emergence of financial populism in DeFi. And I think that's just like a big kind of directional tailwind that I think will get a lot of people pretty excited about the technology.
Well, it's interesting, and it reminds me of something that I heard Vitalik say, that eventually these rates that seem so high now are going to kind of go towards the rates that we've seen in traditional finance. Like, there's nothing really so special about DeFi that's going to increase these rates in perpetuity. It's just kind of a short-term burst that we're seeing high rates now. But I would almost disagree with that, because if we treat capital as a whole rather than just someone's individual capital that they have access to, it seems like capital as a whole is being improved the efficiency is being improved. And I mean, I'll kind of ask this as a question, like, do you guys think that rates overall can be sustainably higher than what we've seen in traditional finance because of that increased efficiency? Or are they just going to tail into kind of the rates that we have seen just more traditionally in lending and borrowing?
Yeah, I mean, it's difficult to say. I think that where like a lot of the yields have come from artificial incentives, just from yield farming, and I think that at some point there's no one left to sell to. As in, that's the whole premise of these yield farming. It relies on there to be more buy pressure than sell pressure. Otherwise, those yields obviously go down pretty quickly. So I think a lot of those artificial yields may decrease and have to be kind of reinvented, and that's all part of kind of tokenomics. In terms of like the real like your lending yields and stuff like that, I suspect that as the barrier to kind of fiat money onboarding into crypto decreases, and I suspect that to happen pretty rapidly in the next 12 months. We've already seen Dharma announce yesterday that users can deposit $25,000 worth of their kind of fiat money in a US bank account to DeFi in like $25,000 per week. That's kind of the beginning of what I think will be kind of dramatic increase in fiat supply into crypto, and that'll inevitably decrease rates because the supply will kind of outpace the demand. So I suspect those rates will decrease, and I think that's particularly why it's important to have different sustainable ways to earn additional yield, and that's what we have tried to build in mStable by having a kind of swap product, AMM, alongside the lending income. So even if that kind of base level lending income decreases, we still have kind of an additional sustainable yield, because we think that there will always be some kind of fragmentation in stablecoins.
Gotcha. Yeah. I mean, that's super cool. And it's interesting to hear that kind of as the friction to onboard between, someone's bank account and DeFi, as that friction decreases, so do the lending rates. Because intuitively, it almost seems like there's more access, and as more access, that could accompany more demand, or at least just easier onboarding into DeFi.
But yeah, I just think it'll be more supply of. I mean, it depends what we think about. Like if we're talking about USD rates in DeFi, that's kind of what I was talking about specifically. Mm-hmm. I think that an increase in supply of USD in DeFi will mean that there's less of a need to borrow if people can onboard fiat money cheaply and easily. But particularly because why would you, if you can onboard money super easily from your TradFi bank account, where you can borrow money for like less than 1%, why would you borrow money in DeFi for like 3 or 4%? So that's kind of where I'm coming from.
Yeah, and the borrow rates on Aave and Compound now are like upwards of like 8%, 10%, 12%. And they're all obviously USD stable coins, and mStable has mUSD, which you can put in the savings pool right now, and I believe I checked it was about 18%. Obviously, we've seen these yields stay around this area in different protocols for a while, and now that we've gone over kind of what is the future of these rates specifically for stable coins, USD stable coin, I'm genuinely curious, James, what you think of these new kind of floating unpegged stable coins like RAI, OHM even, and a few other ones. I'm not talking about the seniorage kind of those ones, but I'm more speaking about this idea of creating units of measure in DeFi that are not revolved around any particular fiat currency, rather revolved around a less volatile form of money, if you will, that is not necessarily pegged to a dollar, but in RAI's case stays, between $2, $3. What do you think about these floating non-pegged stablecoins to the dollar, kind of their own unit of measure in DeFi. Do they have a future? Are they practical?
Yeah, it's that's super interesting. I think you can define stablecoins as being stable to a peg. So like, is your stablecoin stable in reference to USD? But like a more interesting way to define it, I think, is does it have stable purchasing power? I think like in the short term, USD is a pretty good one for stable purchasing power. In the long term, it isn't so good. You kind of see the US dollars are worth less and less if you take kind of like a decade by decade view of things. In the like 6 months, it's a pretty good unit of account and store of value if your time horizon is a bit shorter. So if we can kind of create a DeFi native peg that has stable purchasing power, then I think it's like incredibly interesting. I suspect that's what Bitcoin really is designed to do in the long term. So if you look at kind of gold's purchasing power over time, it's actually really like compared to USD, it's like incredibly stable over like centuries. And I think that like that's what Bitcoin really wants to be that kind of stable purchasing power that's not related to any kind of outside peg. It's obviously will take quite a while for that price discovery to happen. We see kind of people are still trying to work out exactly what Bitcoin's worth. So I suspect to have like a sustainable peg that's not completely independent of anything else, it'll take a long time. And I think Bitcoin, for me, is the one that will do it the best. But there are other interesting kind of ways of doing it as well in DeFi. And I think generally it's pretty smart if it can be cracked, because then DeFi becomes this kind of completely independent financial system. And I think
that's kind of what I was getting at.
Yeah, exactly.
It's like, I mean, I don't anticipate any sort of collapse in currencies. I mean, that's just all kind of far-fetched, I think. The US dollar is backed by the US government and the US military. And that right there is, quite a bit of reassurance that we are in a place of security. Obviously, inflation's happening. Obviously, certain monetary policies with the Fed and stuff is happening. There's a whole bunch of things happening. But point is, if there was one of those events, then DeFi would go down with it currently. However, as you're getting at, if we could kind of spry away from that and get to a place where there is no reliance on that, then yeah. But I mean, at this point, it's the most practical, as you're saying, with the on ramps, with the dollar stable coins, and potentially Bitcoin is supposed to be this kind of store of value and unit of measure over time. But obviously, we're quite a bit away there. It really begs the question, kind of, where is the influence of Bitcoin and the dollar stable coins in DeFi headed? Where do they coexist? Are they there for kind of the market to participate in? One could say, oh, altcoins have been traded against Bitcoin for years now, but now we've got these USD trading pairs. So it really makes you wonder: is there going to be a point in which the existence of stablecoins is less needed than Bitcoin is in DeFi? Because if Bitcoin can sort of solve this role for us, if you will, as this unit of measure and purchasing power, I think we're speaking years in advance here. Then where is the dollar? And well, Bitcoin's traded against the dollar, right? Of course. So I'm kind of going off on a tangent here, but the future of DeFi and unit of measure accounting is something to keep a note of in everything that we kind of think about.
So I think James brought up a great point about the time horizon and how that kind of affects your perspective on why you might use a stable coin. And then to that effect, you have some goal set, and then you want to accomplish that with the stable coin that you're using, and then you might be attracted to different ones for different reasons. So if we look at kind of, since stable coins have existed, I'd say since Tether pretty much was one of the first ones. It pretty much was for onboarding or at least having a synthetic type of a US dollar in a cryptocurrency so that it was ease of transaction. And then, it became, well, are they proof of reserves and whatever, you wanted to make sure that that money was actually there. But now we're kind of evolving to the standpoint where it's a stable coin for a different reason, kind of more of an inflation hedge rather than just ease of access for dollars on a blockchain. And I think that's starting to shape how these stable coins are viewed and which ones are more popular and just more used. Up until this point, it's been Tether and it's been USDC that kind of have dominated the US or the stablecoin market because people wanted that ease of access. But now we're looking at some of these other stable coins as different versions of preserving purchasing power. And Andy, you mentioned a couple of the popular ones right now that aren't necessarily tied to the US dollar, but they're tied to a different measure of purchasing power. Getting away from like CPI as a measure of inflation. There's a bunch of different ways to track it. An index of commodities or whatever you want to base your coin on. And I think that is stretching the time horizon a little bit further. And once we're able to kind of understand, like, okay, this is the cryptocurrency, demographic, right, or just kind of what the population looks right now. It's a matter of preserving purchasing power within that demographic. And if we stretch that even further, rather than different commodities or different things to point to in terms of the traditional economy, we can look at Bitcoin as kind of that future long-term winner, as something that is able to preserve purchasing power the best, opposed to a lot of different other measures of what we can point to. So I think it's interesting as kind of we evolve around this narrative. It's gone from a US dollar stablecoin to now a purchasing power stablecoin to eventually maybe Bitcoin replacing that as kind of the most stable asset or the one that can best preserve purchasing power.
Yeah, absolutely. Yeah, I think generally it's, like, I don't see it as like an either or scenario. We've seen recently that that Visa is going to allow USDC payments and settle on Ethereum. I mean, that's huge, and I think that there's going to be kind of certainly. I mean, my view is that DeFi won't just be this parallel financial system. Like, the financial system will actually rebuild on open protocols, and I think that we'll definitely see just USD and other currencies being used on open blockchains, and potentially even central bank digital currency somehow interacting with open blockchains in some way. But then I think, just given the decentralized nature of this technology, we'll also see a huge amount of innovation in creating these kind of off-peg currencies that are able to retain purchasing power but not be pegged to a certain nation state's fiat currency. And I think that generally just actually creates a pretty interesting political dynamic in the world that we haven't seen in a long time, where there are these kind of currencies that aren't associated with countries. So it'll be pretty interesting to see how that plays out and how governments react to that.
It begs so many questions of what the hell do we do, because we've never experienced this before, and wow, it's moving fast. And I mean, there's like so many things happening here, right? Like, we started with kind of rates and yield and kind of this capitalistic kind of view of making money in DeFi. We can get to the philosophical and the political. It feels like there's so much room for people to come in here and have a place to basically make an impact. That's definitely one of the things that I like the most about being here in DeFi, this ability to kind of just feel like there's an impact to be made and there's a future to be shaped. That's what you're doing with mStable, right? So talk to us a bit about some of these upgrades that you guys have coming up, specifically these feeder pools. I'm not sure that our audience understands what that is, and kind of, if I'm looking to earn some yield with these feeder pools, right? Like, what is a feeder pool, and what's going on there? Yeah.
Yeah, cool. Thanks. Yeah, so all this discussion about stablecoins, it's pretty clear that the future of stablecoins is going to be really interesting, and there's going to be a lot of innovation that happens, and countries are going to generate their own, different regulated entities are going to create their own, different decentralized projects will create their own, even their own pegs. A lot of different assets will move on chain, like gold. So we kind of approached mStable as saying, how can we build infrastructure for this environment? And what we thought would be really useful is to create a mechanism to unify these disparate pegged assets. So instead of just having kind of 5 USD stablecoins, we can create a meta stablecoin called mUSD that is backed by all of these different stablecoins. And if a new one comes out, we can add that into the pool. If one stablecoin doesn't seem so good anymore, it can be taken out. And so we kind of create this future-proof meta stablecoin. And we can do it across every kind of peg. And so that's been like pretty good. And we've been able to get, as we've spoken about before, really good yields by creating certain capital efficiencies with that collateral. But the next phase of mStable's growth is to create these separate trading pools that link into the core, what we call mAsset smart contract. So as an example, we have mUSD, which is backed by DAI, sUSD, a USDC and USDT. So they're the assets that are underlying mUSD. mUSD holders don't necessarily want to just keep adding all the new stable coins that come out all the time as collateral to their meta stable coin, because that creates certain risks, and it's also not very efficient to do that. So what we're implementing are these pools that kind of sit alongside the core mAsset pool and enable trading between them. So we can have, for example, mUSD, BUSD as a pool, and then users can trade BUSD for USDC, and then the mAsset is just in between those two. So we can, a way to think about it is kind of like a solar system. The mAsset mUSD is at the center, and then we have these other pools around that center, and they all can kind of be traded amongst each other. So yeah, generally it'll create the possibility of any asset to be added to mStable. It'll mean that the M assets that are generated actually go back onto mStable. So we generate mUSD from the pool, but that mUSD will go back onto mStable. So it should have some really nice circular effects on TDL. It'll increase trading fees, which we're excited about, and the save APY. And yeah, so the first two pools will be GUSD, mUSD, and BUSD, mUSD. So they'll be incentivized by Meta, our token. And yeah, expect to see a lot more pools to come out in the very near future.
Sweet. So basically, for those who are kind of trying to put the head around where the mUSD token gets its value, its legitimacy, it's effectively a basket of other stable coins which have proven through the Lindy of that they've been around for quite a bit. And so the mUSD stablecoin is now able to have its value and become more liquid, kind of like how the 3 curve pool has their 3 pools. It's kind of a similar aspect of this basket, which creates mUSD. And so basically these feeder pools create more liquidity for mUSD as a token pair, if I'm not mistaken. And basically the incentive here to create this liquidity is through the MTA token through the reward distribution.
Yeah, and also the trading fees that those pools generate.
Right.
So you'll have a kind of a zero and permanent loss. It's stablecoin and stablecoin. So mUSD,
Correct.
BUSD, the price doesn't change, but you can yield farm the Meta token and also earn all the trading fees that pool
And the
generates.
fees.
And we'll also be lending out the assets in that pool. So it should be a really healthy APY. And we have some proposals in the pipeline where other projects are saying, hey, we want to create these feeder pools too. So we'll put, for example, there's a project called ArcX that have a stablecoin, StableX. They want to put StableX and mUSD into a feeder pool, and they'll incentivize it with the ArcX token, and we'll do it with the MTA token. So we could see some really nice double incentives coming out. And then down the track, people will be able to create these pools independently, just like on Uniswap. So you can create just a stablecoin pool. And then we'll also create the ability to trade across assets as well. So you can go from any USD asset to any Bitcoin asset really efficiently.
Yeah, I saw the MBTC.
Yeah, exactly. And then further down the line, we're also looking at ways to enable those transfers to happen at zero or very low slippage across chains or even layers. So that's
really good stuff.
More of an R&D project. Yeah.
Has your main focus been since May of last year? Is it all about the liquidity? I mean, obviously, as much focus is, but is liquidity really the name of the game when you're kind of bootstrapping a DeFi protocol?
Yeah. So, I mean, it's all about product market fit, just like any other startup. And you got to be careful with like liquidity mining incentives generally, because it can sometimes look like you've got product market fit, but actually you just have these mercenary liquidity miners putting on short-term capital to earn the token and then dump it. So you've got to look at the projects, I think, that have more minimal token incentives, like Uniswap, for example, has none. And they have $4.6 billion of liquidity. And that's something that you really is obviously a pretty strong signal that there's product market fit. So we've definitely tried to keep the token incentives to a minimum, and we've seen kind of really good usage across our products, particularly on the Save product. So I think liquidity is certainly a big thing, but I think it's also about number of users, and then there's a whole nother aspect, which is governance. mStable is a decentralized open protocol that's governed by Meta holders. So we always look at the kind of governance statistics as well. So how many governors are participating in, how many MTA holders are participating in governance, how much MTA is staked in order to participate in governance. And, the statistics are pretty good. Last time I checked, we have about 730 governors staking about 7.5 million Meta, and there's about 20 million Meta circulating. So, a good proportion of Meta is staked for governance. Obviously, other statistics are really important. So we've also had about over half a billion swapped on mStable since launch, and those statistics are also really important. But yeah, lots of different ways to track it. And June Analytics is a great way of doing it. We have our own analytics page on the mStable app as well.
Yeah, we've chatted with the Dune team and checked out their dashboards. It's super cool stuff. And that's a great proportion. Almost a third, or at least actually a bit more than a third of holders staking for governance. I know we're running short on time. Is there any proposals that you want to direct some attention to and call out, or any upcoming partnerships, upgrades that you want to definitely mention to our audience?
Yeah, I mean, we've got a whole bunch of things coming up. So the feeder pools are coming out tomorrow, and that'll have some really great incentives. So you'll be able to earn Meta and the trading fees. And if you stake, you actually get a boost in the amount of Meta that you earn. So some really big kind of tokenomics changes and protocol changes are happening in the next 24 hours. We have more M assets coming out as well, and ETH and M Euro. There'll be proposals coming out pretty soon. Generally, there are just also some kind of cool collaborations that we've been doing recently. There'll be a post coming out about how Synthetic DAO swapped sUSD for TUSD, which, because sUSD was overpegged at the time, would have cost us about $200,000, but Synthetic DAO did it in order to get sUSD in the mUSD basket. So some like kind of interesting DAO to DAO collaborations there. And I think just the last thing is that we're also looking for a BD. We're growing really quickly, and we need a super smart business development manager to support us in growing the protocol and our integration. So if anyone's listening who thinks they might be good at that, please, get in touch. mStable.org. You can join our Discord or anything, or our Telegram, and just reach out there. But yeah, thanks for having me on as well. It's been a really interesting discussion.
James, I've got a Metaboy meme for you. Right here, freshly on Twitter. We've got I'm not sure if you guys saw the Silicone picture today of him in his new office with the massive keyboard and the massive desk setup and the monitors. So what they've got is they've got all the mStable stuff on all the screens. They've got the mStable, the Metaboy head, and they've got you with the heart on it in the far left, James.
I saw that. I actually. The funny thing is I actually don't even know who that who
just retweeted that one.
So classic.
Yeah, that's hilarious. He goes, "Hi, I'm Metaboy. I specialize in M asset theory, B asset analysis, and feeder pool F assets." It goes on and on. That's awesome. Yeah, James, it was a pleasure. And yeah, man, thank you so much for coming on. It was an interesting discussion. Stablecoins, yield, mStable, all this stuff. I mean, it's all just so new, and there's so much to explore. And I know our audience got quite a bit of value from this one, and we ought to do it again.
Awesome. Cool. Well, yeah, thanks for having me on again. And yeah, have a good rest of the day.
Thanks, James. Yeah, super cool stuff out on Meta real soon. So we'll definitely keep in touch and stay on it.